If you spend any time listening to finance creators, you're constantly bombarded with conflicting advice about index funds, ETFs, mutual funds, and hedge funds. The sheer volume of jargon makes investing feel like trying to read a foreign language. Strip away the acronyms, and all four of these options are simply pools. You and a group of other investors combine your money to buy slices of a wide variety of assets, like stocks or bonds, instead of trying to pick and manage individual companies on your own. But how that pool is managed dictates your financial future. Choose the wrong setup and you could bleed profits through hidden fees, find your money locked up during an emergency, or take on risks that wipe out your portfolio entirely. This chart maps out the entire landscape along two main axes. On the horizontal axes, we track how the fund is managed, ranging from fully automated and passive on the left to highly active human management on the right. On the vertical axis, we track the cost, from rock-bottom fees at the bottom to steep premiums at the top. Index funds, ETFs, mutual funds, and hedge funds fall exactly into specific zones on this matrix, based entirely on how they operate. This creates a direct trade-off. You must decide if you're willing to give up human oversight to save money, or if you want to pay a steep premium for professional curation. Understanding exactly where you sit in this matrix is how you avoid paying unnecessary percentage points. Over a 10 to 30-year horizon, even a 1% difference in management fees will absolutely destroy your compounding growth. Looking at this comparison matrix, we start with index funds. These sit firmly in the passive column. They don't employ teams of analysts to pick winning stocks. Instead, they run on a system that simply copies a predetermined list of companies, like the S&P 500. Because you aren't paying a star manager's salary, the annual fees, known as expense ratios, drop to fractions of a percent. We're talking anywhere from 0.02 to 0.20% per year. But that hands-off approach comes with a strict mechanical restriction. You cannot buy or sell an index fund at a specific price during the day. All orders are processed at a single net asset value, calculated only after the market closes. Despite that lack of minute-by-minute control, their reliable, long-term performance makes them a favorite among experts. Even legendary investors like Warren Buffett consistently recommend them for everyday people. With an index fund, you trade real-time execution control for the mathematical certainty of rock-bottom fees and reliable market-average returns over decades. If you want the passive tracking of an index but different trading mechanics, you look at exchange-traded funds, or ETFs. These act as a hybrid cousin to index funds, offering the exact same broad diversification. Because the vast majority of ETFs are passively managed, they maintain highly efficient expense ratios, typically hovering between 0.03 and 0.75%. The crucial difference is right in the name, exchange-traded. You buy and sell ETFs on the open market minute by minute, giving you complete real-time control over your execution price during trading hours. That accessibility creates a serious psychological trap. When you can watch your portfolio tick up and down in real time, it becomes incredibly easy to abandon your long-term strategy and make impulsive, emotional trades during market dips. ETFs offer an optimal balance of low costs and mechanical flexibility, but they only work if you have the discipline to hold your positions and resist the urge to overtrade. Moving across our matrix, we hit mutual funds. This is where you hire professional teams to actively decide which specific stocks or bonds to buy and sell. Their entire goal is to beat the market benchmark. Hiring those professionals is expensive. Expense ratios here jump significantly, usually ranging from 0.5% up to 1.5% or more. Over years of investing, those fees act as a massive mathematical drag on your total returns. And despite paying a premium for that active management, you are still restricted to the exact same end-of-day pricing structure as a basic, cheap index fund. There is a specific utility here. If you want heavy exposure to an emerging international market, a very niche sector, or complex asset types that broad indexes ignore, a mutual fund provides that curated access. But the math is unforgiving. Unless that manager consistently picks massive winners, and decades of data prove that very few ever do, the high fees of a mutual fund nearly guarantee underperformance for the average investor. On the extreme end of the active management spectrum are hedge funds. These managers utilize aggressive tactics like short selling and derivatives to chase high returns regardless of what the broader market is doing. To access these strategies, you pay an exorbitant toll. Hedge funds famously run on a 2 and 20 model, a 2% flat management fee, plus a 20% cut of all the profits the fund generates. Because the strategies are so dangerous, the government actually locks them away. By law, they are restricted exclusively to accredited high-net-worth investors and institutions. These managers use heavy leverage, meaning they borrow money to multiply their bets. You give up massive portions of your profit to fees while accepting the genuine risk that a wrong bet could collapse the entire fund and wipe out your capital completely. For 99% of the viewing population, hedge funds are completely irrelevant. Your real decision exists strictly between the first three options. So, how do you decide which of those three pools your money actually belongs in? We can filter your specific financial profile through a simple decision matrix. First, ask yourself, are you an accredited high-net-worth individual looking to take on extreme risks? If the answer is yes, you can consider exploring hedge funds. If the answer is no, you move to Step 2. Step 2. Do you have a high conviction that a highly specific manager or a niche sector will outperform the broader market? If yes, a mutual fund is your vehicle. If no, move to Step 3. Step 3. Do you require the mechanical flexibility to execute trades in real time during market hours? If yes, you buy an ETF. If no, you buy an index fund. Answering those three simple questions cuts through the endless financial marketing noise. It bypasses the jargon and points you directly to the exact vehicle designed for your goals. For the set-and-forget beginner, your path is straightforward. Automate your deposits directly into an index fund and let the system secure your market average returns over the long haul. The trade-off for that simplicity is absolute boredom. To make that strategy work, you must actively ignore daily market news and leave the money alone. If you are a tactical optimizer, stick to ETFs. You capture the exact same passive, low-cost growth, but you retain the mechanical flexibility to buy into market dips in real time. And if you are an opinionated investor leaning toward an active manager, understand what you're buying. Only accept the premium fees of a mutual fund if you absolutely require their highly specific curation. For the vast majority of everyday investors, the path to long-term wealth doesn't require predicting the future. Ruthlessly minimizing your management fees through passive index funds or ETFs is the single most controllable factor in building your financial future.